John Cassidy's Dot.con, How America Lost Its Mind and Money in the Internet Era provides a comprehensive and insightful analysis of the dot-com bubble of the late 1990s and early 2000s. By exploring the causes, key players, and eventual collapse of the Internet boom, Cassidy offers a detailed critique of the cultural, financial, and economic forces that led to one of the most spectacular crashes in modern financial history. The book combines in-depth reporting with sharp economic analysis, making it both a cautionary tale and a historical record of an era defined by speculative excess and irrational exuberance. The dawn of the dot-com era, promise and hype. Cassidy begins by setting the stage for the rise of the Internet as a transformative force in the late 1990s. The World Wide Web, which had grown rapidly in the previous decade, was seen by many as the key to the future of business, commerce, and communication. Entrepreneurs and investors alike believed that the Internet could reshape industries, eliminate traditional barriers to entry, and create massive wealth in a short amount of time. The allure of the new economy was irresistible. Traditional businesses, from retail to finance to media, began to rush online, often without understanding the fundamental changes the Internet was bringing to business models. The rapid growth of Internet access, the proliferation of personal computers, and the promise of new markets created an atmosphere of unprecedented optimism. Cassidy paints a picture of an era when the Internet was viewed as an unstoppable force, capable of transforming every aspect of life and business. As the hype around the Internet grew, so did the demand for Internet-based companies, many of which had little to no track record of profitability or even viable business plans. Cassidy chronicles how venture capitalists and angel investors poured money into countless startups, most of which had no clear path to profitability. Companies like Pets.com, Cosmo, and Webvan, though their business models were largely untested and unsustainable, were seen as the future of commerce. In many cases, investors were more focused on the buzz and the promise of exponential growth than on the fundamental economics of the companies they were investing in. The role of Wall Street, greed, speculation, and IPO mania. Wall Street played a crucial role in fueling the dot-com bubble. Cassidy offers a scathing critique of the investment banks, analysts, and stockbrokers who helped inflate the values of Internet companies. These financial institutions, eager to capitalize on the excitement surrounding the Internet, rushed to underwrite initial public offerings, IPOs, for untested tech startups. The result was a massive influx of capital into companies that were, at best, unprofitable, and at worst, barely functioning businesses. The book delves into the culture of IPOs during the dot-com boom. Cassidy explains how companies with little to no revenue were able to secure astronomical valuations simply by associating themselves with the Internet. In many cases, investment banks and analysts became complicit in this speculative frenzy, often issuing glowing reports on companies they were simultaneously helping to take public. Cassidy highlights the conflicts of interest that arose when analysts at firms like Goldman Sachs, Merrill Lynch, and others were tasked with recommending stocks they had helped underwrite. Cassidy critiques the entire process of how dot-com IPOs were structured. In many cases, companies were able to offer shares at artificially low prices, knowing that they would quickly see a jump in value once the shares were publicly traded. This created an environment where both insiders and investment banks could profit, while ordinary investors were left to take the risk. The culture of Silicon Valley, innovation, disruption, and delusion. The book also examines the unique culture of Silicon Valley during this time, a culture that celebrated innovation, disruption, and risk-taking. Cassidy delves into the personalities of the entrepreneurs who became celebrities in the dot-com era. Figures like Jeff Bezos, Amazon, Larry Page and Sergey Brin, Google, and Marc Andreessen, Netscape, were hailed as the new kings of capitalism, visionaries who could reshape entire industries. Their companies were seen as the embodiment of Silicon Valley's values, relentless ambition, the pursuit of growth at all costs, and a belief that the rules of business no longer applied in the digital age. Cassidy takes a critical eye to the myth of Silicon Valley as a place where anyone with a good idea could succeed. He highlights the ways in which the venture capital industry fueled a culture of extreme risk-taking and unrealistic expectations. The term unicorn, for startups valued at $1 billion or more, was coined during this period, reflecting the overvaluation of many of these companies. Many of these firms, despite their sky-high valuations, had little more than business plans and aspirations, lacking the profitability that typically sustains successful companies. One of the key aspects of Silicon Valley's mindset during the bubble was the belief that the Internet represented a unique opportunity to disregard traditional business rules. Cassidy explores how the Internet was seen as a land of opportunity, where established concepts of profit margins, sustainable growth, and market share were abandoned. Instead, the emphasis was on acquiring users at all costs, often disregarding the financial fundamentals. The false promise of disruptive innovation. Central to the hype surrounding the dot-com era was the notion of disruption, a buzzword that promised to upend industries and radically alter the way people lived and worked. Cassidy explains how the concept of disruption became central to the marketing strategy of Internet companies, even when their business models made little sense. The Internet was marketed as a force that could destroy established industries, such as retail, media, and finance, without offering much in return. This disruptive attitude, Cassidy argues, created a sense of invincibility and irrationality among investors and entrepreneurs alike. For example, companies like Webvan and Cosmo promised to revolutionize online retail and home delivery, despite the fact that their business models were fundamentally flawed. Webvan, for instance, spent enormous amounts of money building infrastructure for a grocery delivery service that ultimately failed because it could not sustain its rapid growth and failed to generate a steady stream of profitable customers. Cassidy critiques the way Silicon Valley executives romanticized failure, portraying it as an essential part of the entrepreneurial journey. While failure is indeed a part of any business venture, Cassidy argues that the glorification of failure during the dot-com era led to a reckless disregard for risk management, and ultimately, widespread financial disaster. The bubble bursts, the aftermath of the crash. The inevitable collapse of the dot-com bubble is the dramatic climax of Cassidy's narrative. As the Internet market became oversaturated with speculative investments, the promises of unprecedented growth began to unravel. The market for IPOs dried up, companies that once seemed invincible saw their stock prices plummet, and many startups that had been floating on a cloud of investor hype were forced to shut down. Cassidy traces the causes of the collapse, from the exhaustion of investors' capital to the realization that many of these companies were not even close to becoming profitable. The fall of Pets.com, which had been one of the most heavily hyped companies during the boom, became a symbol of the irrationality that had driven the market. Cassidy explores how investors began to panic, shedding stocks at a rapid pace and precipitating the bursting of the bubble. In many cases, the fall from grace was swift and brutal, leaving investors with massive losses and a public that had been left with empty promises. Conclusion, lessons and reflections on the dot-com era. Dot.con concludes with reflections on the lasting impact of the dot-com bubble. Cassidy warns that the speculative excesses of the bubble may have set the stage for future financial crises, including the 2008 global financial crisis. He argues that while the Internet has proven to be an enduring force for innovation, the lessons from the dot-com era must be remembered to prevent history from repeating itself. The book serves as both a historical account and a cautionary tale, highlighting the dangers of speculative bubbles, the perils of unregulated financial markets, and the ways in which greed and hype can cloud judgment. Cassidy provides a sobering look at the consequences of irrational exuberance, showing how the hopes and dreams of a generation of investors were dashed by a combination of overhyped expectations, unsustainable business models, and systemic weaknesses in the financial system. In the end, Dot.con is a sharp critique of the speculative fever that gripped the American economy during the dot-com boom, offering valuable insights into the nature of financial bubbles and the risks of blind optimism in the face of economic uncertainty.